Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So last video I have explained you about accounting concepts, accounting conventions, accounting principles, the meaning of these, and also few accounting concepts I have explained like entity concept, money measurement concept, etc. Now this video is the continuation of the last one. And these two videos are the complete theory videos for chapter number 2. Then we'll solve some questions. Then we'll proceed to chapter number 3. So before starting the explanation, take the screenshot of the points. Then I'll explain. Now, the next accounting concept is the cost concept. According to cost concept, the assets should be recorded or any item purchased should be recorded at their cost. And the balance sheet must contain the historical cost of assets. That means whatever are the changes in the value of the assets during the year, that should not be accounted. The balance sheet must contain the historical cost of all the assets. This is the meaning. But there are many controversies regarding this cost concept. So some people says that by following this concept, the balance sheet will not show the true and fair view. Because for example, a land is purchased for rupees 1 lakh some 10 years back. So in the balance sheet, the land value will be shown as 1 lakh rupees only. But during the current year, after 10 years, the value of the land has increased. Now the value of the land is 10 lakh rupees. But in the balance sheet, the land value will be shown as 1 lakh only according to cost concept. That is one of the drawback of the following this cost concept. But if you do not follow this cost concept, what will happen? Unrealized profit will be created. That means if we sell the land, we will fetch 10 lakh rupees. But we are not selling the land. We are using the land for our business. In that case, why to account for present market value? We should calculate at the cost. So normally, a business organization will follow the cost concept. The accountant will follow the cost concept in recording the assets. Next is realization concept. According to realization concept, a transaction or an item will be recorded only when it is realized. If the item is not realized, it will not be recorded. For example, income. An income will be recorded only when it is recognized. If the income is just promised or expected to be earned in future, that income will not be recorded because it is not realized. This concept actually, realization concept will follow the cost concept. So realization concept says if we realize something, then only we record. Example, same example, if the building value is 1 lakh rupees in the balance sheet, we take 1 lakh rupees only because it is a cost, acquisition cost. In the market value, it has been increased to 10 lakh rupees, but we are not recording because we are not realizing. That's it. This is according to realization concept. Dual aspect concept, very important concept in accounting is dual aspect. Every transaction has two aspects, something we give, something we get. So both the aspects must be recorded. That's why one account is debited, another account is credited. This is the base. This dual aspect is the base of double entry system. And double entry system is the fundamental base for accounting equation. All assets must be equal to capital plus liabilities. So this accounting equation is formed from double entry. And double entry system is formed from dual aspect concept. So when we follow, follow this dual aspect concept, what will happen? All the assets. If there is increase in assets, there should be a corresponding decrease in assets. Different assets are there. If one asset is increasing, the other asset must decrease. Or if one asset is increasing, another liability must increase. Similarly, if there is increase in liability, another liability should decrease. Or if there is a decrease in one liability, then there should be decrease in asset. So double effect we should have for every transaction. That is the theme of dual aspect concept. Next comes conservatism. An accountant should be conservative. That means provide all expected losses but don't record any expected gain. If a business forecasts that there may be gain in future, don't record that gain. If there is expected loss in future, that expected loss should be recorded. Conservative, playing safe. An accountant should play safe. By following this conservatism, what will happen? The notional profit will not be recorded. Actual real profit will be recorded. So this is the reason why current assets are recorded at cost or market value, whichever is lower. Example, the stock, the inventory. The inventory is valued at cost price or market price, whichever is lower. Why? Because we are following conservative principle, conservatism principle, right? Next comes consistency. Consistency means uniformity. The same accounting method or same accounting principle should be followed from one year to another year. The accounting principle should not be changed every year. Only under certain circumstances the accounting principle can be changed. For example, if a new accounting standard has been issued, to comply with that new accounting standard, some accounting principles might have to be changed. In that circumstances, we can change. Similarly, if there is a change in the law, when the law changes, the accounting principles may be changed. Or if due to changed circumstances, the management see that to make the financial statement more true and fair, we have to change the accounting principle. Only under these circumstances, accounting principles and methods should be changed. But normally, we should not change every year. What will happen if we change the accounting methods? Where it will be difficult to compare the performance of one year with another year or one organization with another organization. Comparison will become difficult if consistency concept is not followed. Next comes materiality. According to materiality concept, all those transactions which have a material effect on the financial statements, those transactions which have material effect on the financial statements, that should be disclosed separately. That should be disclosed separately. Whereas other small items which does not have much effect on the financial statements should not be separately disclosed. Example, in the balance sheet, the assets. All significant assets like land, building, machinery, furniture, all these things should be separately disclosed. Similarly, under current assets. Under current assets, we should disclose inventory, trade receivable, cash in hand, cash at bank, etc. Small items of assets like calculators are there, small books are there. These are the assets. But we should not separately disclose in the financial statement because immaterial, insignificant items. So insignificant items can be clubbed together, whereas significant items should be shown separately according to materiality concept. What will happen if we do not follow this materiality concept? All insignificant items will also be shown in the financial statements. That will increase the workload of the accountant, and also this is irrelevant from the point of view of user of financial statements. Financial statement users, they don't require all immaterial small things separately. They want to see only material things. That's why we have to follow account materiality concept. The term materiality is subjective term. One more thing. There is no demarcation of the meaning of the term materiality. It depends on the judgment of the accountant, on the discretion of the accountant, on the nature of business. So for one business it is material, the same thing for another business it may be immaterial. So it's only a subjective term to decide which is material and which is immaterial. Now, fundamental accounting assumptions. So far we have discussed the accounting concepts. Now, fundamental accounting assumptions. The three fundamental accounting assumptions are GCA, that is going concern, consistency and accrual. These three are called fundamental accounting assumptions. If nothing is mentioned in the financial statements, then it is understood that the accountant is following the fundamental accounting assumptions. Going concern, consistency, accrual. If a business organization is not following the fundamental accounting assumptions, then it must disclose this fact in the financial statements. After preparing financial statements, a note should be given that the going concern concept was not followed or consistency was not followed, and the reason why it is not followed and what is the impact on the financial statement by not following that. That should be disclosed. Now come to financial statements. Financial statements are the end product of accounting. The accounting will begin from recording the transactions, and accounting will end by the preparation of financial statements. Financial statements are very important. The financial statement consists of profit and loss account, balance sheet, cash flow statement, and a number of schedules and notes. These financial statements are used by a number of users to take rational decisions. The decisions of so many parties are dependent on financial statements. So the financial statement should be understandable, should show the true and fair view. The profit and loss account should show the true and fair profit which the business earned. Balance sheet should show the true and fair financial position as at the end of the year. So financial statements should be prepared with a due care. It must have not only quantitative information, but it should have some qualitative characteristics. That is financial statements. Now last topic is qualitative characteristics of financial statements. Financial statement will have a lot of quantitative information. Apart from that, the financial statement must possess some qualitative information. Qualitative characteristic, not information, characteristic. The qualitative characteristics are the attributes which should be there in the financial statement, which is used, because financial statement are used by so many users to take the decisions. So what are the attributes, qualitative characteristics of financial statements? So many characteristics are there. The first one is understandability. Understandability means the financial statement prepared should be easy to understand by the users. So financial statement should be prepared keeping in mind that these financial statements are used by so many users. So it should be understandable. It should not have complex concepts, or it should not be prepared by using a lot of technical terms, because technical terms may not be understood easily by the users. The first thing, that it should be clearly understandable, easy to understand by the users. Second, relevance. Relevance means the the information provided in the financial statement should be relevant to the user. So we should keep in mind, so many parties will use, why the parties may use, why the particular party will make use our financial statement. So the data should contain the information required by the user. Example, in case of banker is one of the user of financial statement. The banker needs liquidity. We want to find out the liquidity. So to find out the liquidity, the current assets and current liability must be there. So accurate values of current assets and current liability should be there to find out the liquidity which is used by the bankers. Similarly, profitability. So many profitability ratios are there. That ratios will be calculated by using the information from financial statements. So the investors are interested in profitability. So we should have the information regarding profitability in the financial statements. That is relevance. Now reliability. The information provided in financial statements should be reliable. There should not be any errors. The information should not be biased. It should be unbiased. That means it should be reliable. Next one is comparability. The information contained in the financial statements can be compared between different organizations or same organization for one period of time to another period of time. So comparability should be there in financial statements. These four, understandability, relevance, reliability and comparability, these four are called the principal qualitative characteristics. Principal qualitative characteristics are four: understandability, relevance, reliability and comparability. Apart from that, a number of other attributes must be there. The attributes are materiality. That means all material or significant items should be separately disclosed in the financial statement so that the user can be able to understand the material items in the financial statements. Next one, faithful representation. There should not be any misrepresentation in the financial statement because the financial statement are used by the users to take the decision. For example, if there is no fair disclosure, the investors may be misled, the investors may be duped. So this should not be there. Then substance over form. While recording the transactions, that means the substance should overcome the form. Sometimes what will happen? A business has acquired the property. That means the property has already been transferred, but the legal formalities are still pending. Registration, etc. is still pending. So whether we should record it or not, here we should see whether the business is getting the benefit of that property or not. Yes, the benefit is being obtained by the business because it has purchased. The only pending is registration. The legal form is there, which is not completed, but we should record it because substance should come first, legal form should come next. Next one is neutrality. The financial statements should be neutral. It should not be biased. That means whatever happened, whatever transaction took place in the business, that only should be recorded. The recording should not be biased. Next is prudence. Prudence says the assets and income should not be overstated. That means the assets and income should not be overstated by recording the unexpected gain or notional gain. Right. Full, fair and adequate disclosure. Complete disclosure should be made in the financial statements. Nothing should be withheld. Nothing should be hidden. Whatever transaction took place in the business, that should be fully, fairly disclosed in the financial statements. Last, completeness. The financial statements should contain the complete information of the business so that the user can be able to take the correct decisions. So these are some of the qualitative characteristics of the financial statements. So this is the end of theoretical part of chapter number 2, Accounting CA Foundation. The next video I'll give you some questions on these concepts, conventions and principles. So if you're satisfied, give a like to the video, share my channel among your groups, among your friends, so that more students can watch the video and enhance the knowledge and qualify the CA Foundation exam. Give your comments, subscribe my channel if you have not yet subscribed, and by the super thanks which is given below my video. Inshallah, we'll take up the next topic in the next video.